you guys have. So we got the Buydown programs, the temporary Buydown programs. That's been really popular the last few years. So I'll let you explain what the temporary Buydown, the difference between a temporary Buydown and a permanent Buydown.
Okay, so a permanent Buydown, and a lot of people are somewhat familiar with this. It's where you pay more in closing costs to get a lower interest rate. And caveat to that, one thing that a lot of people don't know is a mortgage loan officer cannot be paid legally based on rate and fees. That's actually been illegal since 2011. It was part of Dodd-Frank. So when people are paying points, I think that some old timers or people that haven't had a mortgage in a long time think that this loan officer is getting rich off their loan when really the loan officer is trying to get them a better interest rate and create, a tax advantage or just make the loan affordable. So that's a permanent Buydown, is where you're paying more in points or closing costs to get a lower rate than what you qualify for. The temporary Buydown, the most common, is the 2-1 Buydown, and that's where the loan is 2% lower than the note rate, so the long-term rate for the first year, and then at the 1-year anniversary, it graduates another percent. So, for example, if your note rate, your long-term rate is 6.5 and you're on a 2-1 Buydown, the first year your rate would be 4.5, and then at your 1-year anniversary of your loan, it will go up to 5.5 for another year, and then as entering into year 3, then the rate would go up to 6.5 and stay there thereafter. Now, there's also a 1-0 Buydown, and there's also a 3-2-1 Buydown that work similarly. So again, say your rate's 6.5. If you're on a 1-0 Buydown, the first year your rate would be 5.5, and then at the 1-year anniversary, it would graduate. And on the 3-2-1 Buydown, same theory. If your rate is 6.5, you would start the first year at 3.5. 1-year anniversary, you go to 4.5, another year 5.5, and then 6.5. And the thinking behind it is that you would either refinance or that your financial picture will change and it will become more affordable, because it's proven that more times than not, people's incomes go up, their situations change, and their life becomes more affordable. And so graduating and kind of building up into a higher payment is also feasible for a lot of households. If you do end up refinancing before you finish the period, so say you're on a 3-2-1 Buydown and you're only halfway through it and you think, I don't want to waste all of this that I worked for to get this temporary Buydown. If you refinance it before it's graduated to the full note rate, then whatever portion of the seller credit that was given at closing to make the temporary Buydown work is then credited to the payoff on the next loan. So that money is never lost. It's held actually in a suspense at closing, technically, for the life of the temporary Buydown.
And you said it's the seller's funds that we're so that's another thing I think we need to also let our buyers know, is that it's something the buyer doesn't pay for this. A seller will pay for this. So you have a good agent like me. We go ask the seller, we would like some extra funds to do the temporary Buydown. It's very, very common right now. Everyone's doing it right now. Homes are sitting on the market a lot longer than they used to. So sellers are wanting to get their homes sold. So they're going to try and contribute as much as they can to make that happen. We ask the sellers to contribute some money to this Buydown. Like you said, it sits in an escrow account, and they just pull a little bit out every month to make up that difference between the note the rate where it is and then the Buydown rate.
Exactly.
And then when it's all said and done, if you refi within a year, whatever's left in that escrow account, you put it back onto the principal, and it's your money. It's always your money.
Yes, it is. It is your money as it is credited to you. It can only be paid. It cannot be paid for by the buyer, so it can only be paid by the lender or the seller. The reason why nobody ever asks the lender is because then, kind of going back to the permanent Buydown, if the lender has to pay for it, they have to build it into the cost of the loan. So then the rate goes up, and then you're completely defeating the entire purpose.
So I didn't even know that. I didn't know you could ask the lender.
You can ask the lender, but a lot of lenders, because I've even tried to make it work in certain scenarios where I was paying for part of it, or our company was paying for part of it, and then the seller was paying for part of it. And I've gotten it to work before to some capacity, but like I say, if you're doing a temporary Buydown to get 2% lower, but then your long-term note rate is going to be 0.75% higher because we have to build on this credit for you, then it starts to kind of feel like, why am I doing all of this?
It's all washing out in the end. So it doesn't really makes sense to go that route.
It takes strategy. Yeah.
So those are that's very, very popular right now, the temporary Buydowns. The permanent buy downs are kind of expensive, right? So it's not necessarily a route you want to go with a permanent buy down, but some buyers are more comfortable doing the permanent buy downs.
I think it depends. Different strokes for different folks. Sometimes I'll show people you could take this higher rate and have these lower closing costs, or you could pay all of these closing costs and have this lower rate. The other thing is when you buy down the rate, all of those points are considered prepaid interest. So the tax advantages are there. I typically, if I'm planning on keeping a loan, I typically will buy a rate down somewhat, but I'll calculate it. And I think that that's one of the benefits for somebody to sit down with their loan officer is kind of run the pros and cons of each, because people don't know what their taste is. And a lot of times a loan officer, if they don't get the chance to sit down with the consumer, they'll tend to decide for the consumer.
Mm-hmm. Yeah, so it's always good to sit down with your lender and find out all your alternatives, all your options, and what's going to work best for you. If you got more money out of pocket that you're okay with and you can buy rate down, great. If you don't have as much out of pocket and you want just the lower closing costs, figure it out.
Yeah.
Yeah.
Exactly.
All right, so let's move on from that.